to the report of the 6th of November. Come, let's jump in first into the events. Now, this week would be move on. Now, today, I'd like to talk about the bank term funding program and its impact. I believe many have not heard about this or heard of me about it once. It's not a surprise because it's not something that is brought up, but I would like to bring it up already because, you know, sometimes human memories, they tend to forget, they're short of certain things. But because this bank term funding program is expiring in the next 3 months, I would like to bring it up because when you understand this thing here, you would actually understand the financial health of the banks in the US. Now, banks are the anchor of any economy. If there's something happening to the banks, you can see the economy will have a bit of headache because bank deals with money. Okay, that's why I think this is very, very important that I want to bring up today. Now, in March 2023, the Federal Reserve initiated the bank term funding program. Okay, it is an emergency lending conduit to infuse, i.e. to put in money, liquidity into the US depository institutions amidst a financial emergency, right? So this action was precipitated by the abrupt failure of signature banks. Remember, all those banks, they had failures, right? Signature Bank, First Republic Bank, and the Silicon Valley Bank, marking the most significant banking collapse since the 2008 crisis. So here, the BTFP's sole objective was to support depositors, encompassing American businesses and households by channeling additional funds to eligible institutions. This ensures these banks retain the capacity to fulfill the demands of their depositors, right? These small banks here, just to give you a history, just so you forget, these small banks here, they actually, you know, they can't compete with the bigger banks like the Bank of America, like JP Morgan. So they are, they use different financial means to build financial ways and also take higher risks to lend out to individuals or businesses that, you know, carry higher risk from a lending perspective. And you know, when the interest rates started moving up higher and higher and higher, this actually affected the industry, where what you call the tech industry, and a lot of these banks actually lend it to the tech industries to grow. So when that happens, you know, when this kind of things happen, so it's not they lack of liquidity. So, and usually banks, they shore up their liquidity with the US bonds. So with and you know, the unprecedented increase in the US yields, the bonds, right, the value of the bonds drop. Now usually bonds are very safe because they, you know, they don't fluctuate much, and then if the banks want to leak some liquidity, they can sell the bonds. But because of the rate, the Fed is increasing the speed of it, the bonds that they were holding, the value became lower and lower and lower. So they would take a big hit, financial hit, if they sell it at the current moment. If they can hold it until the bond expires, they get everything, principal plus the interest, but they couldn't. They need depositors, they were like panicking, they want to withdraw the money. So that was the cause of these bank failures, because they ran out of cash, right? So Federal Reserve said, okay, we have this tool, which is the BTFP. Now, this BTFP thing, it helped cool the market down, because the market was in a panic. You saw that all the banking stocks, they were crashing, right? Now, this program here is intended as a temporary emergency measure. and it's set to wind down on March 11, 2024. Okay, so basically we are just 3 months away. So unless the Fed renews it, you're going to see this. This is the expiry date, 2024. Now, the core concern is the trajectory post-BTFP, particularly its expiration on March 11, 2024. This extra date here is very, very important. Why do I say that? Because look at this. Now, this is the chart of the Asset Liquidity and Credit Facilities Loan Banks Term Funding Program, right? So if you look over here, when it was created in March, right, straight away you saw it went all the way to 80 billion US dollars. The banks, they needed 80 billion US dollars to, as you know, what they did is they passed the treasuries to the banks, and let's say they have I give you an example. Let's say they have 10 billion in treasuries, but if they were to sell it at market rate, right, they would have a huge loss. Let's say, I give an example, a ballpark figure, let's say 80% loss. They're staring at an 80% loss, right? But if you pass that thing over to the Fed and said, Fed, here, these treasuries are worth 10 billion. Right now, it is just 2 billion. I cannot sell it. I sell it, it's a big loss. Can you hold it for me? In return, because I pass this to you, you give me my 10 billion so I can do my business first, and then later, I'll take it back later on, all these kind of things, the arrangement. So where that kind of transaction, we saw immediately it went to 80 billion US dollars, and that's where the Fed, Jerome Powell, Janet Yellen, everybody saying like, oh, things is good, it's fine, don't worry, right? Don't worry. So this momentum is anticipated to decelerate post-crisis aversion. We are at that juncture where everybody says it's fine right now. So why is this going up? Why is this value still going up? Because this is contrary to expectations. The data here depicts a continuous borrowing trend from the Fed by the banks, instead of projected decline as the one-year termination mark approaches. So this is a true cause of concern, because question marks now appear, right? Because it exhibits a borrowing uptick, underlining a possible persistent financial quandary. There's still maybe this problem is still ongoing, right? So no matter what, the Fed say is a tool, Jerome Powell says it's a tool. You have Janet Yellen also saying it's a tool, it's not a bailout. To me, no matter how you see it, I call it a bailout. A bailout is a bailout. And the impending question is the sustainability of the bank should the Fed discontinue the BTFP. Okay, so why do you think the Fed want to discontinue it? They said this is good, it's helping. They might just say, let's continue this whole thing. Okay, now we have to look into a few areas how this whole thing started first. Now, first of all, both U.S. Treasury Secretary Janet Yellen Powell and Fed Chair Powell have remained reticent, emanating a facade of stability. They say everything is fine. Now, concurrently, the lingering inflation appears unaffected by the bailout, hinting at inadvertent support over here, right? So inflation, as you know, is still sticky. The bailout is not helping in reducing the inflation, but supporting it instead. They are saying this is stable. I don't think so, because inflation is showing stickiness, right? So looking ahead, it's prudent to closely observe the Fed stance on the BTFP over the ensuing 3 months. A cessation of the program, coupled with a stable banking sector, would bode well for financial fronts. Okay, if they stop it, banking sector stable, it's a good thing. They did well. Conversely, if they prolongation could unveil enduring instability within the banking sector. As this may be worse. Okay, so if we hear something like if they stop it, because one of the reasons why they stop is that the banks are the ones contributing to inflation because banks handle money. Okay, so if they tighten their lending, tighten everything, you would actually see deflation. Okay, or if the Fed had not get this thing program running, immediately you would see things all come down. But the Fed had to do the BTFP program to avoid a systemic failure in the banking sector. Right? They had to. But when they do that, it's like ensuring that, you know, this thing is going to continue. And that's the whole reason why they are always saying that, you know, this is really bad. Inflation is sticky, because of this, right? So that's why I said it's crucial right now. It comes to the end of the year. From here, we would know whether the facade of stability projected by both Yellen and Powell, is it really concrete or not? Okay, if it isn't, then I don't see any reasons why the economy, what they say, the soft landing, that could actually be achievable. Okay, so just work out in those for the next 3 months. Look out. I believe that this word you will tend to see very, very soon. Okay, the bank term funding program, they're going to talk about it soon, probably in the last month or the last 2 months of it. Okay, so that is the fundamental update for today. Let's move on to the charts.